Yeah, so you can see we came out here. We entered here. We stayed in for half an hour, 45 minutes. What's that? Yeah, around that. We came in here. It's 1, 2, 3 candles. It's not much. It seemed like it was going against you, but if you look at this, it's going against me. But look at this. Do you see these moving averages? You see how it's opening up? Can you see this? See the mouth just opening up? Look, opening up like that. When it's opening up like that, it's a good sign to stay in. But I didn't want to risk it. I got a 1-to-1 ratio. I was happy with the progress. But if we just left the stop loss, which was up here, where's the stop loss? The stop loss was here. If we just moved it down slightly, maybe to just there, just leave it, it would have been about a 17-point stop loss, and we just leave it, we should have been alright. But the only problem with that, like I said, I've seen it aggressively turn plenty of times on me. Plenty. So for example, see if I said, oh yeah, alright, let me leave it here, this could have happened over here, which I said earlier. Comes down, pretends it's not doing nothing, then it comes down again, and then it just moves. See, here we would have expected it to come back. See, it would have bounced off the 10. It didn't bounce the 10. It closed above the 10. That's a sign where you get out. But then you would have lost all your profits. So instead of risking that, because this could have happened here, it would have stopped there, and then I would have maybe I would have just got a couple of pounds out of that, or a couple of pips or whatnot. But instead, we let it ride and took the 20. So we would have got maybe 10 pips out of that. But in saying that, we could have come out, right? Then look at the Williams. If you look at one Williams, there's no problem. It's still under. Here, the Williams popped out. Yeah? So we could have come out where we did, but we could have went back in. Look. Wait for it, wait for it, wait for it. Boom. Here, we could come back in. So if we came back in here, we would have risked. We would have risked 20 pips again, and we would have look. See, we won't make the ratio at the lowest point. Look, we don't make the ratio. We'll still be in it. We'll still be waiting, and it's popped back out. And this is arguably, has it? No, it hasn't. I wouldn't say that has closed above. That's closed on the 10, not above. But it's entirely up to you what you want to do. I think I'm usually looking for 20 pips. No, sorry, 30 pips a day. That's what I'm looking for. I've got 20 today. I'm happy with that. I'm happy with that, because it could have been easily a lost day. Because really, today is one day after the bank holiday. I've read so many books. They say don't trade one day after a holiday. It's crazy. Blah blah blah. Don't trade on holidays and stuff like that because of liquidity and what can happen if, for example, when it's a bank holiday, for example, there's not much liquidity in the market. So therefore, if one hedge fund or one big player in the market does something, does a transaction, it can make it very volatile. Whereas in another market, when all the banks are open and stuff, when that hedge fund guy done whatever he did, it wouldn't even trouble the market. So basically, bank holidays and stuff like that, medium-sized players make big waves, whereby before they didn't. So if you're on the right side of the market, I suppose it'd be alright, but if you're not, it's a bit of a big problem. that's why people don't really like messing with it. So getting 20 pips on the day after bank holiday in Japan is cool.